Hi, this is P R Sundar. Welcome to this special episode where I am going to talk about myth and reality of intraday players. I don't know who started this. Somebody started this strategy called 920 short straddle. And what is the logic behind this trade? What people do at 9:20 in the morning, they go and sell both call option and put option. And of course, 1000 point or 2000 point away, so they buy some hedges. First, what is the logic behind this trade? Number one, market. There are three possibilities. Market can go sideways, market can go trending. Trending, it can be uptrend also, it can be downtrend also. Or the market will be choppy. Choppy means market go up, then come down, again go up, again come down. The third possibility is very little. Markets will be mostly either trending or it will be sideways. So if market goes sideways, both call option and put option prices will come down. At the end of the day, they'll make some profit in call also, some profit in put also. So they make some profit. Second, assume that the market is trending. Let us say market is trending upside. If the market is trending up, the call stop loss will be hit. They will put, after selling the call and put, they'll put 50 rupees, 60 rupees, some stop loss. Some people, they put stop loss in percentage terms. So when the market is trending on the higher side call stop loss will be hit. But if the market continue to trend for the rest of the day, the profit in the put option will be higher than the profit in the call option. So still they will make money. Market goes sideways, they make money. Markets go trending, also they make money. But what happens on a choppy? Market goes up, it hits the call stop loss. Again the market comes down, it hits the put stop loss. Of course, most of the time what the people will do, once the call stop loss is hit, the put stop loss they will be revising to cost. So even if market reverses, they will exit the put position with no loss, no profit, but call options loss is still loss. People think that, market can be sideways or trending, but choppiness is rare. But what is happening for the last few months, the markets every day, there is some kind of a choppiness. A market goes higher, profit booking comes, and FII buy, market goes up, the DII sell, market comes down. So it's going all over the places. What some people do, instead of doing it at 9:20, some people, divide their capital into 5-6 components. They do one lot at 9:30, one lot at 10:30, one lot 11 o'clock like that, but still they are finding it difficult in this market condition. Many people, they may come and post, this is verified MTM. Today my MTM profit is 1 lakh, my MTM profit is 2 lakh. Okay, and don't be misguided by looking into all those things. So this is just an awareness video and not to offend anybody, So SEBI is also doing the awareness. Whenever you log into any trading portal, the pop-up message comes, 90% of the traders lose money in Indian stock market. So this is just an awareness video. Here, I'm just looking at one strategy for today. Bank Nifty is trading around 46,100. Suppose if somebody is selling 46,100 call and put option is around 300 plus, a call option is also 300 plus. 1,000 point or 1,500 point if they buy some hedges, so that hedges may cost about 55 rupees on the downside, and 1,000 point away, the hedge costs about 40-50 rupees. Now, here I am just taking a margin calculator. So here I am just putting, I think about half an hour before it was 46,200. So I put 46,200. So you sell both call option and put option, and then you buy the hedges about 1,000 point away. You see your margin is hardly 42,000, right? So that means assuming that your capital is, let us say, 45,000, you still can do one lot in this strategy. Now, I'm assuming while selling call option, let us say you sell the call option for, let us say, 320 rupees and buy the call option for 300 rupees. I'm assuming that you are doing 2 lots at a time. So for 2 lots, your charges works out to be around 65 rupees. For selling 2 call options, brokerage, STT, stamp duty, change transaction charges, SEBI charges, everything put together, this works out to be 65 rupees. I am taking a discount broker who charges 20 rupees per order, right? I am assuming that you are doing 2 lots at a time. Of course, if you do more lots, your transaction cost may come down slightly. If you do only 1 lot, your transaction cost will be higher. So, for selling a call option, you are getting about 65 rupees charges. Assuming the same thing you are doing on a put side, you will be paying another 65. Hedges. When you buy the hedges, let us say you are buying the hedge for, let us say 30 rupees and squaring it up for 25 rupees. There, the charges works out to be 50 rupees. So, call side by 50 rupees charges, put side by 50 rupees charges. So, I just put it in Excel. You are selling 2 calls, total charges 65 rupees. Sell 2 puts, total charges 65 rupees. Buy 2 calls, total charges 50 rupees. Buy 2 puts, total charges 50 rupees. So, this total works out to be around 230 rupees per day. 230 rupees is the total charges per day. And now, if suppose this guy says, my capital is 45,000, I made 450 rupees profit. Today I made 1% intraday. That is not true. That is not 1%, because 230 rupees will be going away from the charges. What they show you is only the MTM. It is not the net profit. So, when the half of the money is gone for charges, so his profit will not be 1%, his profit will be 0.5%. And the worst thing is that when he shows a loss of 1%, his actual loss is 1.5%. If you continue to do this over a period of 1 year, there are 250 trading sessions in 1 year, the total charges work out to be around 57,000 rupees. This is for 2 lots. Okay, I assume that you are doing 2 lots. So, for 2 lots, your capital itself is 90,000. Out of the 90,000 capital, almost 60,000 rupees is gone for charges. And STT, stamp duty, stamp duty has been increased 2 times in the last 5-6 years. The STT is very high. Stamp duty is there. The worst thing is that stamp duty you have to pay both the sides. Of course, brokerage, GST and brokerage and all those things. So, I have calculated per lot. This for 2 lots. For per lot, it's almost 30,000. So, your capital is 45,000. So, 30,000 is already gone for charges. That's almost 65%. Now, I am not taking into consideration losses on trading, like slippage and those kind of things. But here only, because when people do back testing, they say, I did the back testing, I got 60% profit, 70% profit, but then whether that back testing does not take into all the charges and it does not take into slippages into account. So, if you put together everything, almost 100% will be gone. Okay, so that means anything more than 100% you make, that is for you. In which world people can make 100% every year? Okay. Now, not only this, I think this one I have discussed roughly earlier also, but now I have discussed in detail. But now let me tell you one more important thing. Let us say, by paying so much charges, okay, you still made some profit. Okay, but what about the taxation? Now, many people think, sir, who pay the tax, full tax? And people will show a lot of expenses. People will show office rental, electricity bill, all other employee cost and those things. Remember how the tax works. Your income minus expenditure. Let us say your income is 100 rupees, your expenditure is 60 rupees. That means your net profit is only 40 rupees, you pay tax only for 40 rupees. But for intraday players, that is not allowed. Okay, for intraday players, you cannot show any expenses. In a business, so there are 2 types of business income. One is speculative business income, the other one is a normal business income. For normal business income only, you can show the expenses. If you are buying a lottery ticket, if you are getting the prize money, or for any other lottery or any other thing you are getting, So that income is considered as a speculative business income. So trading in futures and options is considered as a normal business if you are doing a positional trade. If you are doing intraday trade, it is considered as a speculative business income. For speculative business income, whatever is the profit, you have to pay straight away the marginal tax depending upon your tax slab. Most of the people will be under 30% tax slab, so they have to pay 30% plus surcharge. It will work out to be around 35%. So you cannot show any expenses. You have to pay straight away 30% plus surcharge. So you pay nearly about 60-70% for STT, stamp duty, brokerage, GST and those kind of things. Then you pay another 20-25% for these slippages, and then on top of which, assume that you are making some profit. You are not eligible to show any expenses in your books of accounts. You have to pay the tax directly for your entire income. So that is the objective of this video. There are many people who do only intraday, and do remember, if you make a mistake, the income tax department will come back to you after 4 or 5 years, and then they will say, this is a mistake you have done. You have to pay penalty, you have to pay interest for 4 or 5 years and like that. So that will be a hell lot of a problem. I will advise you not to trade intraday. So that is the objective of this video. But of course, if you are confident that you can make more money than what the charges and the taxation, of course, you can go ahead and do it. And second one, the objective of this, there are many intraday players without knowing this income tax rule, they are paying less taxes. So this is an awareness video for them. So you are not allowed to show any expenses, you have to pay full tax. Hope you enjoyed watching this video. Thank you for watching.